At Barchart, we like to test our toolkit to see if it's actually working properly, and more importantly, if it's giving our users exactly what they need: high probability trades. So I did just that. A few weeks ago, I wanted to test out our options screener and see how well it worked for our new accounts that are on a free trial. I use the default filters for 4 of the most popular option strategies today on 2 of the most popular companies right now, Meta and Microsoft. 4 trades, 2 different outlooks, and well, the results, they couldn't have been better. Actually, I think they'll surprise you. That's why in this video, I'm going to show you exactly how these trades were set up and what happened after the market made its move. Now, before I jump into the actual option strategies, let me quickly frame how to think about these examples. For each stock, I'm going to express the directional opinion in 2 different ways. One trade is going to be more speculative, with higher upside but higher risk using a long option. And the other is a more risk-defined trade where you collect a premium and don't need a huge move in order for the trade to win. And for that, I'm going to use a credit spread. With long options, the stock needs to make a strong upward or downward move to overcome time decay. With spreads, you're not just looking for a big move, you just need the stock to stay on the right side of your short strike price. Then there's the expiration date. Generally, I prefer trades with more than 30 days to expiration, so that's the range that I'm going to focus on today. I also want to point out that I chose 2 stocks precisely because they're releasing earnings before the options expire. And finally, I wasn't expecting to hold these positions to expiration. I just wanted to see how these trades behave after a major move with time still left on the clock. Same direction, different tools, and very different risk-reward profiles. Now, let's get onto the trades, starting with Meta. At the end of October of last year, Meta's stock price dropped from around $750 to below $600 after it released its third quarter financials. Now, many pointed to excessive capex and a miss on expectations, and since then, the stock traded below $680. In early January, the stock was trading around $643. If you're bullish on the stock, you could have bought a call or sold a bull put credit spread. Now, the goal of a long call is to profit from a stock rising above the strike by expiration. If you're wondering how it works, I made a video breaking it down that you can check out up here. In any case, the long call screener can be found right here, and back in January, I changed the date to February 13th, which was 32 days away at the time, and the results came in with the suggested trades all at different strike prices. Again, this is speculative, but let's say you bought the $665 strike for $21.35 a share, thinking that Meta will exceed $665 before the expiration date. Of course, since this is an out-of-the-money call, at least at the time, it means that the strike price is higher than the current stock price, and it has around a 28% chance of profit. That's pretty normal for an out-of-the-money call. On the other hand, maybe you want to sell a put instead. Now, being short a put means potentially buying 100 of the underlying, but maybe you don't want to obligate yourself to do that. So you sell a bull put credit spread instead. It's an option strategy where you collect a premium by selling a put and then buying a lower strike put with the same expiration and the same underlying. The long put sets a floor on the trade, limiting the risk. Bull put trades can be found on the vertical spreads page right here, and they have their own tab. Now, bull puts are much more risk adverse than out-of-the-money long calls. So let's say you chose the 600, 560 spread right here and collected a $7.50 per share premium. This trade has around a 25% chance of ending at a loss. As long as the stock trades above $600 by expiration, well, you get the full premium with no other obligation. So for both strategies, you want the stock to move above a specific strike price. For the long call, the higher the stock price, the higher the potential profit. For the bull put, as long as the stock price trades above your $600 short strike, you make money. Actually, if you want to know more about credit spreads, I also made a video about it, which you can check out right here. So let's jump forward by 22 days and see how it all went. Fast forward to today, the day of recording, and Meta is now trading at $691. The stock rallied following Meta's release of its fourth quarter and full year 2025 financial results. Both top and bottom lines exceeded Wall Street estimates. So let's see how much your long call and bull put trades are worth now. Well, your $665 strike long call is now in the money. Remember, you bought it for $21.35 a share, and now it's worth $33 a share. That means you can now sell to close your trade and make $1,165 of profit per contract. Of course, you do still have 10 days before the expiration date. So you can either sell to close the contract now or wait to see if the stock will move higher within those 10 days. Of course, it could also drop. Just remember, though, that options lose value faster the closer they are to their expiration date. I think it comes down to experience, but I'd imagine that most of us would probably book the profit at this point. Now, for your bull put, the spread no longer even shows up in our default results. So the spread is essentially worthless, and that's the best possible outcome. So you've got two options here. You can either close out your trade for practically nothing to wipe away any risk of assignment, or you just wait until expiration. Either way, as long as Meta doesn't drop below $600, you get to keep all of your initial premium. And again, the more experienced traders that I know will have already closed out this trade at around 80% of their maximum profit. That means closing out when the premium dropped to around $1.50. Plus, this wasn't even the trade with the lowest probability of loss. All of these trades right here would have resulted in gains. But let's switch gears for a moment. Microsoft has been doing quite well the past year, but maybe you think a correction is coming. Back in early January, Microsoft was trading at around $477. So let's say you decide to either buy a long put or sell a bear call spread, both of which are bearish trades. So a long put is an option strategy where you buy a put option to profit from the stock falling below the strike price. Most traders, though, will use this to protect a pre-existing position. You can access the default screener in the same place as the long call, just switch the tab. Then, let's say you bought a $460 strike put on Microsoft and paid $8.95 a share, or $895 per contract, with the same expiration date on February 13th. Again, it's out of the money, so profit probability is going to be low at 26%. Now, a bear call spread is a strategy where you collect a premium by selling a call option and then buying the same one at a higher strike while expecting the stock to stay below your short strike. And the goal is for the stock to trade below that short strike at expiration. And like the bull put, bear calls are risk defined, so you'd want to start with a higher strike price. So let's take, for instance, the 500-515 call spread, and you'd get $3.45 a share, or $345 per contract. Now, it has a lower risk-reward ratio than most of the results here, and the trade has a 27% chance at ending at a loss. The point is, for both strategies, you want the stock to trade lower. For the long put, the further the stock price falls below your strike, the higher the potential profit. For the bear call, as long as the stock price stays below your short strike, you make a profit. Well, fast forward to today, which is 22 days from the initial screening date, Microsoft is now trading around $411, a few days after its fourth quarter financial release. Like with Meta in the previous quarter, analysts are worried about how much the company is spending on AI and if it'll actually make sense down the line. So let's see how our long puts are doing today. Well, your $460 long put, you know, the one you paid $900 for? Well, it's now worth $50.35 a share, or $5,035 per contract. That's $4,000 in profit right there. And that bear call, it's so far out of the money that it too doesn't even show up in the screener. That means it's practically worth zero. And again, you can either close out that trade or just let it be. Either way, that premium is mostly or fully yours as long as Microsoft doesn't shoot above $500 in the next 10 days. So what you've seen so far is just the bare bones of our premium option screener. Through the screen and set filter functions, you can further customize your trades according to your own exacting preferences. And we actually have a lot of videos on our channel that'll show you how to customize your trades for different option strategies and market outlooks. We also have our ultimate cash secured put short screener, which you can watch right up here. And it's actually a really good deep dive on the subject, especially if you want to get paid to wait to potentially buy a stock. But at the end of the day, we're here for the screener. Instead of scrolling through hundreds of contracts and hoping something works out, with Barchart, you're letting the data do all the heavy lifting for you. So if you want to sign up for Barchart Premium on a 30-day free trial, go ahead and scan this QR code or click the link in the description. But with all that out of the way, screeners are just tools. They're powerful tools, yes, but accuracy, it's never guaranteed. Markets can move in wild ways, and even with millions of data points that are used to show all the metrics that you see in our option screener, any single unexpected piece of news can change the planned outcome. So always treat screeners as a starting point, not a final decision. Use them to narrow the field, then layer in your own research, risk management, and common sense before putting real money on the line. Now, before I go, I want to hear from you. Do you actively use option screeners in your own trading, or are you more of a manual chart-first kind of trader? Let me know in the comments below. And while you're there, if you found the video helpful, don't forget to like and subscribe because it helps others find this video, it supports the channel, and it makes sure that you don't miss out on our next deep dive. Well, that's it for me today. Thank you so much for watching, and I'll see you next time.